I just mentioned that the S&P 500 posted its ninth consecutive weekly gain. This is a rare occurrence historically. And the key question for us is how long will this winning streak be going on? And how long can we sustain this winning streak in the market? Welcome to Life in the Markets. I am Steve Verkler, a wealth manager here at Life Financial Group. And today is Monday, June 1st, 2026. Ongoing reports of a Middle East ceasefire helped investor sentiment last week, and it boosted major equity indexes, all of which posted record highs. And one of those major indexes was the S&P 500, and this is now 9 consecutive weeks that we have seen an increase in the S&P 500. Again, all three major U.S. stock indexes had gains last week, record highs. NASDAQ was up 2.89%. The S&P 500 advanced 1.4%, and the Dow Jones Industrial Average was up 0.9%. We're going to talk in a little bit more about the Dow Jones. I just mentioned that the S&P 500 posted its ninth consecutive weekly gain. This is a rare occurrence historically. Over the past 70 years, that has only happened 12 times. And these have tended to happen fairly early in the bull market cycle. So that bodes well for the next 6 to 12 months, although there are no guarantees, but it is a good sign for us as well. And the key question for us is how long will this winning streak be going on, and how long can we sustain this winning streak in the market? The U.S. equities continue to move higher. The S&P 500 has logged 22 record highs in 2026 alone. That's a lot. And you may be asking, what is the record for the most number of record highs in a year? Well, we have to go back to 1995 when there were 77 record highs that year. Now, we have a ways to go to hit that, but 22 so far in 2026 is an encouraging sign. The S&P 500 has gained more than 18% since the close of the first quarter this year on March 30th, while the tech-heavy NASDAQ has risen 28%. Last week, the best performing sectors were technology, up 4.5%, and basic materials were up 1.74%. What didn't perform as well? Energy, which is not surprising considering what's going on in the Middle East right now. Energy's down 5.31%, and consumer defensives were down 3.09%. So what has contributed to this market winning streak? Well, you've heard it here in some of our podcasts, some of our Life in the Market episodes recently. Technology stocks have been really driving the growth, as well as resilient earnings from a lot of the large tech companies out there. AI-driven demand has driven this and has played a key role as well. And a good example of this is Dell Technologies, which had a 30% jump in shares this past week. And overall, tech has been a major reason why the S&P 500 rose 16% in the month of May. And there are signs of a broadening market as well. The S&P 500, we've already talked about, has been up, but also small cap indexes have reached new highs in May as well. So it's an encouraging sign that we have a broadening growth across the board in different sectors across the market. And it's not just tech as well. In the month of May, cyclical sectors such as financials, industrials, and materials also posted earnings growth of more than 20%. So there's broad strength in much of the corporate fundamentals that are being posted out there. Also, I want to make sure I mention oil prices. Oil prices were almost 10% lower for the week, trading near $88 per barrel. And of course, there are hopes that the Strait of Hormuz would reopen soon, and that was largely responsible for this. So it was an especially good week for oil. We're seeing oil move in the right direction. We will see what happens, of course, this week in the Middle East. It was an especially big week for the Dow Jones Industrial Average on a few fronts. We mentioned record highs. The Dow Jones Industrial Average all-time record high close was 51,032.46, and that was set this past Friday, May 29th, 2026. The index also posted an intraday record high of 51,094.18 during that same trading session. So that was big news for the Dow Jones Industrial Average. Also, the Dow Jones had another big day last week, and that was on Tuesday, May 26th. And what was that? That was the Dow Jones Industrial Average's 130th birthday. That means that this has been around for more than half as long as the United States itself. And the Dow Jones has tracked the U.S. equity market through 24 presidencies. We have to go all the way back to Grover Cleveland when the Dow Jones Industrial Average first came into being. So what is the Dow Jones Industrial Average anyway? Well, it's the oldest industrial stock index in the U.S. and one of the oldest in the world. On May 26, 1896, a man by the name of Charles Dow took 12 industrial companies, added up the stock prices, divided by 12, and then published his result. These eventually became known as the Dow Dozen, and it has evolved quite a bit over the last 130 years. It started with 12 companies across various industries and then expanded to 20 in 1916, and then to its current 30 in 1928. And what happened the next year? In 1929, the stock market crashed. Many of us are well aware of that. And the Dow Jones Industrial Average took on an increased relevance after the stock market crash. Before the crash, there was a focus on individual stocks. After the crash, indexes such as the Dow Jones Industrial Average became a barometer for how well the overall market was performing, and it increasingly became a trusted source for the public. The methodology has changed quite a bit over the last 130 years, but the objectives have not. Today, it remains a key and trusted measure of the performance of 30 of the largest U.S. companies across multiple sectors, and it offers a helpful snapshot for the overall health of the U.S. stock market. These companies that they track are often called blue chip, and they're often very large with significant revenue and also some of the largest employers in the country. Take a look at this chart. You can see this shows the performance of the Dow Jones Industrial Average since its inception in 1896, and you can see how this illustrates the growth in the U.S. equities market during that time period. And of course, past performance is no guarantee of future results, but this is also helpful for us to see how steady overall the U.S. stock market has been over the past 130 years. It's going generally in the right direction. We want to see that going up, and the Dow Jones Industrial Average is helpful for us in seeing how well the overall market is performing. So we want to give a shout out to the Dow Jones Industrial Average. Happy birthday, Dow Jones. We appreciate what you do. This past Wednesday, an inflation report was released which tempered some of the optimism that we have seen with the strong market growth. Headline PCE rose 0.4% for the month of May. So what is PCE? PCE stands for Personal Consumption Expenditures. Now, this was largely in line with expectations, but it's still a little bit of a concern. The April data showed its highest reading in 3 years, and there was a 5.5% increase in gasoline prices, which could have had a lot to do with that. But the primary measure of consumer spending on goods and services in the U.S. economy is what the PCE is. Now, there's also something called a core PCE, and this core PCE excludes food and energy. So it's roughly 2/3 of the total domestic spending. And this rose 0.24% in the month of May and 3.3% over the 12 months through April. And this is the fastest growth since 2023 in the PCE. And this is a 3-month annualized rate of 3.8%. Now, the Federal Reserve has a target for this of 2%. So you can see that this is higher than what the Fed wants to see as far as the PCE index. The Fed uses this price index as a main tool as it makes monetary policy changes or decisions, and more specifically about interest rates. Now, some Fed officials have expressed concern about this rise in inflation. In fact, Fed Reserve Governor Lisa Cook characterized this trend as, quote, clearly moving in the wrong direction. Now, there is a divide within the Fed and the central bank over how persistent these risks of inflation are and how much they should be concerned about them. The next Fed meeting is coming up on June 17th, so it will be interesting to see how this will affect that decision with the interest rates at that meeting. They're also going to be looking at other things, supply chain disruptions, labor market changes, and evolving trade policies as well. But the inflation is something they are definitely going to be taking a look at. The general consensus is that the Fed will not make any changes. But we will wait and see on that on June 17th. Now, it's not just the Fed that's concerned about inflation. There are COOs and CEOs of major companies out there that have expressed some concern as well. One of them is Goldman Sachs COO John Waldron. He is the number 2 executive at Goldman Sachs. And just this past Thursday, he called out inflation as, quote, the single biggest risk element to the economy. It's the one that worries me most personally. Waldron said that if longer-end interest rates continue to move higher globally, quote, that can have an impact on the cost of capital across the economy and consumer behavior. So we are going to be keeping a close eye on inflation in the coming months for sure. Something else last week that we learned is that consumer confidence dipped, but less than expected. So there was some bad news, but also some good news in there as well. In May, the Consumer Board's Consumer Confidence Index declined to 93.1. It was the first drop in 4 months for that index. Forecasts had pointed to 91.9, so that fact that it landed at 93.1 was somewhat encouraging. There are still concerns about the economy out there among consumers. Inflation, which we've already talked about, oil and gas prices, and of course the geopolitical risks that we are very much aware of in the headlines in the Middle East. Now, a few other things that Consumer Confidence Index pointed to is that 2/3 of shoppers are cutting back on spending due to rising prices, and many are delaying expensive purchases and buying cheaper versions of the same item. So the CCI still remains slightly below its historical average, just slightly, so still something to be concerned about, but consumers are still cautious overall. Now, the one good thing is that consumer spending still remains resilient. There is a stable labor market out there, and there are healthy household balance sheets as well. So consumers are continuing to spend, but they're doing so cautiously. One very interesting thing that happened on Friday after that consumer confidence report came out is that retail stocks surged among 3 very different parts of the retail sector. For example, Kohl's. Shares of Kohl's soared 25% based on stronger than expected sales. Also, Best Buy. The electronics seller said revenue across major categories was off to a strong start, and they had an 8% gain. Dollar Tree was up 16% after that consumer confidence report came out, and they highlighted customers are spending more per transaction at their stores. Interestingly enough, customers are spending more on each transaction as the number of purchases fell 1%. So customers are spending more when they're in the store, but they're going to these stores less frequently. So that's really interesting to see what that's about. Again, consumers are cautiously optimistic, and maybe gasoline prices may be a factor in that as well. So what does all of this mean? It appears that we have a lot of conflicting data this week. There is optimism, but it's also mixed with caution. So the key phrase for this week is consumers are cautiously optimistic. Now, also optimistic are leaders of the nation's largest banks. They continue to see resilience across the economy based on a number of factors: healthy consumer activity, which we just talked about, stable employment trends, and solid corporate balance sheets. Now, there is some cause for concern among them as well. Some things they're keeping an eye on, of course, are energy costs, the geopolitical uncertainty, what's going on in the Middle East, and uncertain business confidence. They're seeking more clarity around economic conditions over the next 6 to 12 months. But again, they are optimistic, but there's still some things that they are cautious about and looking ahead to see exactly how things play out over the coming weeks. So what can we expect this next week? Well, the monthly jobs report comes out this week, and it's expected to show a solid pace of job gains of around 100,000 and a steady employment rate of about 4.3%. Those are the expectations. So we'll see what that jobs report actually says. In addition, we're going to be taking a look and keeping an eye on what's happening in the Middle East, the overall market, how will it respond? There is a ceasefire that's temporary right now. We're waiting to see how President Trump responds to that. But the market has responded well, as we have seen. And oil prices. Oil prices are coming down slightly. And will they continue to do so based on the negotiations and a potential ceasefire? So those are some things we're going to be taking a look at this week. A recent Reuters survey of market strategists, analysts, and portfolio managers expect the S&P 500 to finish 2026 slightly above the current record levels. So that's good news. There is a divergence, though, between strong earnings fundamentals, which we have talked about, and elevated ambiguity and uncertainty on the macroeconomic global level as well. And really, this divergence is probably what's going to define the rest of 2026. No one knows for sure. Again, cautiously optimistic is really the phrase that comes to mind as we think about the market and where we are at this time. It's a wait-and-see attitude from business leaders all the way down to consumers. So what do we need to do with all this information? As we think about how long this market winning streak could last, here are some things that we can do. We need to continue to have long-term discipline in our investments and be prudent in how we invest, and continue to stay well diversified. As we continue to face a world and markets that have a lot of uncertainty, we can know that our true optimism comes from the hope that we as believers have. Romans 5:13 says, "May the God of hope fill you with all joy and peace in believing, so that by the power of the Holy Spirit you may abound in hope." Our prayer for each of you is that, despite the uncertainty in the markets and what the future holds, that you would abound in the hope that we all have in Christ Jesus. Thanks for joining us this week for Life in the Markets. God bless.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.